In this video, we'll go over how to read and analyze a real company's balance sheet. When I was learning accounting, it was always using simplified examples of fictitious companies, and I found that a bit frustrating as it's not very realistic. So in this scenario, we're going to be looking at Amazon's real balance sheet. But first up, to make sure we're all on the same page, what is a balance sheet? Well, it's one of the three main financial statements alongside the income statement and the cash flow statement. In short, the balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, which are the assets, what it owes, which are the liabilities, and what's left, which is the shareholders' equity. As you can see, the balance sheet has the equation of assets equals liabilities plus shareholders' equity, and that always has to balance, hence why it's called the balance sheet. In fact, you can rearrange the same formula to be assets minus liabilities, and whatever is left is shareholders' equity. At this point, you might wonder, why is a balance sheet even important? And that's because it helps investors, creditors, and a lot of other stakeholders assess a company's liquidity, its financial health, and its capital structure. By analyzing it, all these stakeholders can determine whether a company can meet its short-term obligations, how efficiently it uses its assets, and how much leverage it has. Now that we're all on the same page, let's take a look at Amazon's balance sheet. Here it is in this PDF file that's got 89 pages and it's known as a 10K annual report. If I scroll all the way back up, this is what the form looks like, Form 10K, and we can actually just find it in Amazon's investor relations page. In this case, you can see I've just filtered by annual filings, and that's how I found this PDF. Back to the balance sheet here, and you can see the general structure is that it's got assets up top, and then it's got liabilities and stockholders' equity down below. Stockholder and shareholder are used interchangeably, and you can see that total assets up here equals total liabilities and stockholders' equity down below. As we saw in the accounting equation earlier, these should always match, as is currently the case. That's a big picture, and now let's go over each line item, starting with the asset side. You'll notice that it's split into two main areas, which are the current assets and the non-current assets. Current assets are simply those that the company expects to convert into cash, use, or sell within the next 12 months. If we look at the line items we've got here, first up is cash and equivalents. The cash equivalents typically refers to investments with a 3-month maturity, like a US government bond, which is known as a treasury bill. Then we've got marketable securities, which in this case have longer maturities than 3 months most likely, but less than 12 months. For example, it could be a 6-month or a 12-month treasury bill. Then we've got inventories, which in the case of Amazon are goods that are available for sale. For example, they're books in their warehouse that they're just waiting for someone to order. Accounts receivables are payments that are owed to Amazon, so it's an asset for Amazon. For example, maybe a business has been running ads on Amazon, but they still haven't paid them because payment is due in 30 days. That would be accounted for as an accounts receivables. That wraps up the current asset side, and now let's take a look at the non-current assets. Here we've got property and equipment, which is usually things like Amazon warehouses, data centers, etc. It's got that net there because it's net of depreciation. Just like when you buy a car, after you use it for a year, its value goes down. The same thing happens with the warehouses, fulfillment centers, etc. So that's why we've got that net to account for that depreciation. We've also got operating leases, which give Amazon the right to use the leased properties like a fulfillment center. Then we've got goodwill, which can be a bit confusing, and this originates from Amazon acquiring another business for more than its fair value. So companies with a great brand value like Nike, Apple, or Ferrari, you're willing to pay for a bit more than just its fair value, and that excess is known as goodwill. Other assets are long-term assets that don't quite fit into any of the other buckets, and they're just put there as a catch-all. With that, we've got the total asset side, and now let's look at the liabilities side next before we can analyze it with some ratios. Much like the assets, we have them split into current and non-current. Again, assets are things that we own and liabilities are things that we owe. So in this scenario, we've got accounts payable, which is the opposite of accounts receivables. That means these are goods or services that Amazon's been invoiced, but it hasn't paid for yet. Down below, we have accrued expenses, which are somewhat similar, These are expenses that have been incurred but not yet paid. For example, these can be employee salaries or employee bonuses where the employees have done the work but they only get paid at the end of the month. Unearned revenue sounds a bit counterintuitive. It's basically when Amazon gets paid for something it hasn't delivered. For example, in a gift card where I might buy a gift card, so I've paid Amazon, but whoever I'm gifting it to hasn't redeemed it yet, that's an unearned revenue. That wraps up the total current liabilities, and because we've calculated the current assets and the current liabilities, we can then calculate a ratio. The first ratio we have is the current ratio, so it's simply current assets divided by current liabilities. This is going to assess Amazon's ability to cover any short-term obligations. You can see I've computed the numbers here for 2024, and we've got a ratio above 1, which basically means that if all the obligations were due today, Amazon would still be able to meet them. Looking at the non-current liabilities, first up here we've got long-term lease liabilities. This is, for instance, if Amazon leases a fulfillment center, it's supposed to record all of the future payments it's gonna have as a liability. Long-term debt is just money that Amazon borrowed that's due in more than 1 year. And finally, other long-term liabilities are usually things like tax liabilities and other obligations. And finally, moving to the last section, we've got shareholders' equity. And people sometimes struggle to understand what this is. It's simply whatever is left by doing assets minus liabilities. So if you were to sell off all your assets and pay off all your liabilities, what would be left? As an individual, you can kind of see this as your net worth. If you have all your assets that you sold and you sold all your debt and other liabilities, whatever is left would be your net worth. So this is the equivalent for a company. Here we've got preferred stock and common stock. Although Amazon doesn't have preferred stock here, let's quickly define it. In short, common stock first is normal shares in a company, in this case in Amazon, that have a voting right, whereas for preferred stock, you don't have that voting right, but you have a fixed dividend payment. Also, preferred stock has a priority over common stock. That means that in the case of a liquidation, if Amazon were to sell all its assets because they've gone bankrupt, then the preferred stockholders would get paid first. They would have priority over the common shareholders. In case you're wondering what I mean by voting rights, basically whenever there is a very large decision for a company to make, like if it's gonna get acquired, sometimes as a shareholder, you're going to have the right to vote on it. So if you own preferred stock, you're not gonna have that right. Moving down to treasury stock, and these represent shares that Amazon actually repurchased from the market. So when Amazon buys back shares, it's known as treasury stock. And you might wonder, why would Amazon do that? And it's basically to boost the share price. If there's less shares in the market, that means that the share price is going to go up. And same thing goes for the earnings per share, as there's less shares in the market. If you've been paying attention at the numbers, you might have realized the common stock amounts are relatively low at 100 million-ish. This is because you'll see that the common stock is at $0.01 par value. That 0.01 is an arbitrary amount, and it can be quite confusing. So the common stock par value is multiplied by the 10.9 billion shares issued, which reaches that 109 million. But that's not all the money that Amazon's been able to raise by issuing common stock. The remainder there is the amount paid above the par value, and that's known as additional paid-in capital. That's the issue price minus the par value times the shares issued. So you can see that APEC, which is short for additional paid-in capital, is the large majority at 120 billion in 2024. Moving lower down, accumulated other comprehensive income is relatively small at minus 34 million. And this typically includes things like foreign currency adjustments or other unrealized gains or losses. Finally, we've got retained earnings, which are basically Amazon's cumulative profits over time that they've decided not to distribute to shareholders as dividends. And with that, we've reached the totals, which are balancing out as total assets equals to total liabilities and shareholders' equity. At this point, another ratio that we can use for analysis is the debt to equity ratio. Basically, this is gonna show us how much debt does Amazon have relative to its equity. Some people use total liabilities over total equity, while others just stick to total debt over total equity. It's quite normal that the number is greater than 1. In Amazon's case, it's 1.19. Generally, below 2 is considered safe, but keep in mind that these are just rules of thumb, so because it's high or because it's low, you shouldn't just outright decide not to invest in this company or to definitely invest in it. Another common ratio just using the balance sheet is the retained earnings growth. Looking at Amazon's balance sheet numbers, you can see that retained earnings is growing from 2023 to 2024. Having this growth just means that the company is clearly having a profit. It's not distributing that profit over to its shareholders through dividends, and so it's deciding to reinvest that profit in the company. As we can see right here in the calculation, it's around a 52% growth for Amazon. Because there's hundreds of ratios out there, in this scenario we only used some balance sheet specific ones, but usually they combine the balance sheet and the income statement, and so let me know down in the comments if you want a video on the top 10 ratios. One thing to note about balance sheets that I wish someone had told me earlier is that not all companies have the same line items. For example, over here, if we take a look at Amazon and we take a look at Apple, you'll notice that their line items are actually fairly different. You can see here we've got vendor non-trade receivables for Apple's scenario, but this isn't a line item that's available for Amazon. If we go lower down, we also have line items like commercial paper over here, which wasn't available in Amazon's liabilities section. This is completely normal, and it's actually what makes it a bit harder to analyze a balance sheet for a real company compared to just a fictitious example. If you're liking this teaching style and you want to learn things like financial accounting, finance, valuation, or financial modeling in Excel, I'd recommend you check out our complete finance and valuation course where you can learn all of these essentials. First, we'll cover financial statement analysis using Apple's real annual report as an example. Then we'll get into financial modeling through a 3-statement model on Apple. After that, we begin the valuation phase where you learn to do a discounted cash flow, a comparable company's valuation, and a precedent transactions valuation on Adobe, looking at their real financial statements to eventually derive a valuation range. Lastly, we'll show you how to present an investment thesis in a stock pitch format. So if you're interested in checking this out, head over to the link in the description below. Alright, to learn some common accounting interview questions, watch this video over here, or you can take our complete finance and valuation course over here. Hit that like and that subscribe, and I'll catch you in the next one.